Hi, my name is Paul, and welcome to my coverage of the Morguard North American Residential REIT's fourth quarter results for 2022. What I'm going to be doing here is I'm going to go through and break down all of the important information that came out in the quarterly earnings report and conference call, and then I'm going to briefly go over how I'm valuing the stock and what my plans are going forwards. But first, I want to highlight what I'm expecting before having actually seen any of the results. And just so that you're aware, this part was written beforehand and comes directly from my personal notes. So if my expectations don't line up with what you hear in the quarterly results, that's probably why. Now, really quickly, for anyone who might have clicked on this video not knowing anything about the Morguard North American Residential Real Estate Investment Trust, this particular security is one of 3 different Morguards that trade on the Toronto Stock Exchange, and its shares trade under the ticker symbol MRG. As for what the REIT does, Morguard mainly owns and rents out apartment units in major cities and urban areas throughout Canada and the United States. Transitioning into what I'm expecting to see from the management this quarter, first off, based on the projections given last quarter, I'm expecting continued average monthly rent per unit to grow in both Canada and the US. Now, the majority of the REIT's Canadian properties are located in Ontario, and during the quarter, Ontario had guidelines in place limiting rent increases on existing tenants by 1.2%. But because those limitations did not extend to new leases, the REIT should have been able to, on average, increase Canadian AMR above the 1.2% limit. And in the US, there aren't any limitations on recurring renters, so that, in addition to the projected strong rental market demand, should contribute to continued strong rent prices. Next, I think that occupancies will be pretty stable, since both the Canadian and US properties were already well into the 90% occupancy range last quarter. However, the Edmonton property in particular, which had been lagging due to extended COVID-related challenges, should finally see occupancy recover to near standard levels. So I'm expecting Edmonton occupancy to come in somewhere around the mid-90s% range. This quarter, I am also expecting to see the net asset value decline, since it's hard to imagine that properties will again see rising valuations in the slowing real estate market. But last quarter I was pleasantly surprised, so who knows. Next, I'm expecting to get an update on the search for a property that will allow the REIT to defer the remaining $60 to $65 million of taxable money from their previous dispositions, which can be sheltered under the 1031 exchange so long as something is found within the next 3 or so months. Finally, I'm expecting to get some more information regarding the recent stock repurchases and dividend hike, especially since the REIT had seemingly been opposed to doing buybacks in previous quarters. Getting into the report, you can see here that the average monthly rent did again increase in both Canada and the United States. Canada's rents in particular increased by 3.5% year over year, with all areas seeing increases except for the Alberta property. Just underneath this, there's even more information where it was shown that fourth quarter rents in Canada rose by 1% or about $15 from where they were in Q3. And that happened despite the previously mentioned 1.2% annual limitation on existing tenants in Ontario. The reasons given for these increases were the completion of capital projects, i.e. renovations, which create an exception that allows above guideline rent hikes in order to recapture some of the money put into improving a property, for which the REIT has filed 2 applications, but the more important reason was the higher levels of suite turnover. This turnover has its own section a little bit further down, where it's noted that over the course of the year, the REIT saw tenant turnover in nearly 20% of their Canadian suites, and the new leases that were signed were at rates that were on average 13.7% higher than before. Also, on the conference call, we received some additional insight into the early performance of Q1 2023, where it was mentioned that January's rent growth on turnover in Canada came in 3 percentage points higher than was shown at the end of Q4. So that points to the continuation of the recent rental growth trend, and also highlights how much the previous rent control policy in Ontario was suppressing normal market pricing. That said, the current guideline in effect for 2023 has been raised to 2.5%, which is still a little bit low, but that's probably going to be the bare minimum for what we can expect rent increases to be for the REIT's Ontario properties in 2023. And if in 2024 there is further easing of these guidelines, then the REIT will very likely be able to achieve much stronger rents. Now, a little bit further on in the report, we got an update on the Edmonton property, which saw its average rents per unit decrease by 3.3%, which was noted as having to do with the softening rental market in downtown Edmonton. This obviously isn't good news, but at least there isn't rent control in Alberta, so the REIT will be able to increase rents once the market recovers. On the more positive side of things, the Edmonton property did increase its occupancy to 92.1%, which is up over 3 percentage points from last quarter. So while rent prices were down, the higher occupancy more than makes up for those declines, especially when comparing the year-over-year numbers. Looking over at the US properties, they saw rents up a strong 13.1% year-over-year, going from $1,536 per month to $1,771 per month. Unfortunately, the growth compared to Q3 was not included in the description for the US properties, which I initially assumed was because sequential numbers were bad, but that actually isn't the case, and you'll see that shortly. But for now, I guess we'll just assume that they forgot to put them in, because it is an annual report and they are more focused on annual numbers, though they do have other sequential numbers further on in the report, so I'm really not sure why they didn't include it here. Anyway, we did get a note explaining that rent and occupancy in the United States is expected to continue performing well as we move into the winter months, because there isn't enough supply to keep up with the demand for rental units. On the topic of occupancy, the Canadian properties experienced a quarter-over-quarter increase from 93.8% to 98.6%. So quite strong there, but over in the US, occupancy had a slight decline, going from 95.9% down to 95.3%, and this was explained as having to do with the housing market cooling off. Delving a little bit deeper into this, it was stated that the trend of homeowners selling their homes and moving into rentals is starting to slow down on account of the continued interest rate hikes by the Federal Reserve. That said, on the conference call, US occupancy rates were considered by the management to be well within optimal operating levels. Also, going forwards, it was projected that occupancy should remain fairly stable through the winter months. So, all in all, not the greatest news here, but the recent trend of high occupancy and record rent growth wasn't something that was baked into my hypothesis, and definitely wasn't something that was going to last long term. Now, in the report, we also got a first-time performance update on the recently acquired Echelon Chicago building, which had AMR come in at $2,366 with occupancy of 94.5%. And I just wanted to point out that it's nice to see that the recent acquisition is performing so well. To conclude this segment of the report, this graph shows the rent and occupancy change on a quarterly basis. And as you can see here, the AMR in the US was in fact higher than in the previous quarter. So I don't know why they didn't just include it where it should have been included in the previous section. And the last thing that I want to tack on here is that right underneath the graph, it was noted that rent collections were normal. Moving on to the next segment, here we can see the impact that the higher rents had on the same property rental revenue throughout the year, which did of course see a similar increase. And the only difference between the total revenues and same property revenues is that the same property figures don't include rental revenue generated from properties that were bought or sold or otherwise weren't operational within the period. And the reason why I like to look at the same property revenues as opposed to the total revenues is just because the same property metric gives me a better idea of how the existing business that will still be there in the coming quarters has grown. Now, it's here that we also get a look at the net operating income, which takes into account the profits generated by the properties, but it doesn't take into account any of the non-operating expenses, like an interest expense, since interest is generally something that's owed on debt, and debt is not required to operate a property. It's for these reasons that debt and interest payments are classified as financing expenses. That said, I like to look at the proportionate net operating income as opposed to the standard NOI, since the proportionate metric depicts the realty taxes directly linked to the properties, but it excludes tax strategies used by the REIT that can make the numbers look a bit misleading. For instance, if the REIT uses a tax deferral strategy in order to maximize shareholder profits, this might make NOI look better or worse than it actually is on a year-over-year or quarter-over-quarter comparison. To give you a quick hypothetical example to help you understand this effect, in 1 year, the REIT could defer $100 million in owed realty taxes, but the next year, they might have to pay off, say, 50 of that deferred $100 million. This would create a scenario where last year's numbers look $100 million higher since they paid $100 million less in taxes. But this year's net operating income would look $50 million worse because the REIT would be paying off last year's deferred taxes. So to normalize the effects of these tax discrepancies, like the deferral in our example, I like to look at the same property proportionate net operating income, which this year increased by over $20 million, or 16.9%. And this is very nice to see since it shows that there's organic growth in the REIT's existing properties. And most of this growth is directly tied to the increasing rents and strong occupancy that we saw earlier. But it also has to do with the relatively slower growing same property proportionate operating expenses, which increased by a bit over 9% on the year. And most of this operating expense growth came from higher repair, maintenance, and property management fees, wage increases, higher insurance premiums, increased administrative costs, and slightly higher utility costs, of which you can't really do too much about. Now, all of that having been said, the interest expenses are still very important to keep track of, and as you can see here, the interest on mortgages have increased. In the past, I have explained, however, that I generally don't like to look at the REIT's listed totals down here, and this is because my goal is to assess the regular recurring cash outflows that go towards interest payments. But the totals shown down here in the report include things like amortization of payments that have already been made, or that are one-time payments that can't be expected to happen again, or in the case of those pesky convertible debentures, are indicative of a future one-time expense. To save everyone who's already seen me talk about these in past videos, I'll direct any newer viewers who want to see this topic discussed in more detail to the video shown on screen. Getting back to the interest expenses, what's highlighted on screen now are the sorts of expenses that I believe qualify as interest-related cash outflows that can be expected to regularly occur. And if we tally them up, it shows that the recurring interest expenses have actually increased from about $58.15 million to $61.99 million, which is an increase of about 6.7%. This is very different from the totals shown in the report, which indicate a 3.1% decrease in interest expenses. So this isn't really ideal, but again, this growth is much slower than the growth of the net operating income. Now let's take a look at the funds from operations, or FFO, which, unlike the net operating income, includes both the operating and non-operating expenses. So the FFO should give us a better portrayal of the REIT's actual profitability. And just as a quick refresher, the reason that we don't use standard net income for this, which this quarter in particular looked exceptionally bad, is because it includes non-cash outflows. In the case of a REIT like Morguard here, the net income is heavily impacted by the change in value of the appraisals of the REIT's properties. To showcase this, you just need to look at the highlighted line item here, which shows that Morguard's properties decreased in appraised value by almost $213 million this quarter, as opposed to Q4 of 2021's increase of $132 million. Again, these figures do not indicate cash losses or gains. They just show the change in how much the properties are being valued at, which doesn't really benefit us if we're trying to figure out how much the REIT actually earned in cash profit from their business operations. That said, looking at the year-over-year property values, despite this quarter's decline, the properties are still being appraised as worth $206 million more than in 2021. Going back to the funds from operations, the diluted FFO per share came in at 40 cents this quarter, which is 11 cents higher than in Q4 of last year. However, this again doesn't tell the full story if you're looking to get a beat on the regularly recurring cash inflows. See, if we dive a little bit deeper into the report, it's been highlighted that about 5 cents of this increase was due to higher rents and stronger occupancy, which is fair. But we can also see that 4 cents of this performance was due to foreign exchange gains, which cannot be counted on to regularly happen, so that will need to be deducted. Also, as you can see here, there was a 3-cent positive impact from the 1031 exchange, which came via tax deferral on property sales, and this shouldn't really be considered as normal operating income either, so I'm going to deduct that as well. In total, that's going to reduce the 40 cents of diluted FFO per share down to about 33 cents per share, which is still considerably higher than the 29 cents put up in Q4 of 2021. As for the year-over-year comparisons, we have to make similar adjustments, So I'll take the $1.47 of diluted FFO per share and subtract the 9 cents of positive foreign exchange gains. Then I'm going to add back the 1 cent that was lost on acquisition-related costs, since that isn't really part of the REIT's usual business operations. And finally, I'm going to deduct the 6 cents of proceeds from the 1031 exchange. So all in all, the REIT had adjusted annualized FFO per diluted unit of $1.33, compared to $1.13 put up in 2021, which is a gain of about 17.7%. So the REIT put up some really strong FFO numbers, and that's obviously good news. Next, I want to dig into the acquisitions and dispositions, where it was announced that the Coconut Creek property was officially sold early on in the quarter for a net gain of about $70.6 million US dollars. And that figure comes in after factoring in the closing costs and mortgage repayments. This disposition helped to bump up the REIT's liquidity to $270 million, $98.5 million of which is held on the balance sheet in cash. Plus, there are an additional $102 million of unencumbered assets that can be sold if needed. So there's definitely a good bit of room to make future deals. That said, some of this liquidity has already been drawn down, because the REIT also announced that subsequent to the quarter's end, the trust purchased the remaining 246 units in the Fenestra building at the Rockville Town Square in Maryland for about $105 million US dollars, which includes the mortgages that the REIT assumed. And I have a few things to say here. First, this acquisition pushes well past the $60-ish million mark, representing the amount available for tax deferral under the 1031 exchange. So the REIT will almost certainly be able to defer paying taxes on the full sale value of their dispositions done in the prior year. This, of course, is good news on its own. But in addition to that, if we multiply the $2,051 in monthly rent already being earned on a per suite basis in Maryland by the 246 suites acquired, we can estimate that this acquisition will bring in roughly $6 million US dollars per year. Then, if we take that $6 million and factor in the $105 million acquisition cost, we can deduce that the REIT purchased these suites at a cap rate of about 5.7%, which is generally considered to be quite cheap for a building of this caliber. Anyway, with this acquisition completed, the REIT now owns all of the Fenestra building and the adjoining Rockville Town Square mixed-use retail property, which should allow the REIT to improve the entire location in order to maximize public interest. So that's just another piece of good news to conclude the report. But we did get some additional news that I want to cover from the conference call. First up, the management commented on the recent 2.6% dividend hike, noting that we should expect very conservative dividend raises in the future because the management wants to leave open their options with regards to capital allocation. Plus, this ensures that the REIT doesn't get ahead of itself given the current economic circumstances. And it was also mentioned that there is room for further dividend increases as well. Then, with regards to the future outlook of the US market, it was acknowledged that rent growths have been slowing down a bit, and some of this has to do with seasonality, but mostly it had to do with the aggressive growth throughout 2022 just slowing down naturally. Even still, the management does expect rent growth to return to normal levels, but they do not believe that rents will decrease from here. On the call, it was also noted that rents are currently well ahead of management's previous expectations and that rents will likely be able to keep up with inflation. Lastly, it was mentioned that deal flow has slowed down a bit, though there are still some deals to be had. They're just a little bit further and farther between. And now for the bombshell of the quarter. On the conference call, an analyst asked why the REIT trades at such a large discount to its net asset value. Given that the assets are currently trading at the high end of their historical range, and that share price hasn't increased alongside it, this is a really good question, and one that I've been pondering myself for quite a while. The answer that was given was because the REIT already has one large unit holder, the parent company, Morguard Corporation, this further restricts the already low volume of shares regularly available on the open market. So this, of course, would make it very difficult for an interested larger investor to accumulate a significant position in the trust. And to throw my own 2 cents in on the matter, I don't think that most Canadian retail investors with smaller sums are interested in buying securities that aren't common blue chip names or that haven't been hyped up. And briefly speaking beyond the topic of this video, I think that this makes the Canadian markets a place where you can find a lot of really good opportunities if you're willing to dig for them. Returning to what was said in the call, the management further went on to explain that they've recently been working to bridge the gap between the share price and net asset value. And they're doing this by, get this, repurchasing shares. Let's go. Since the beginning of January, it was announced that the REIT has already repurchased over 56,000 units, which is about 3.8% of what they're actually allowed to repurchase within the year, but it's still a really good start, and I'm very happy that they finally decided to start doing buybacks. The reason that I'm so excited about this is because these buybacks play directly into how I'm valuing the REIT. Now, we do already know that the property appraisals were marked down this quarter, which is the main contributor to the Morguard North American Residential REIT's asset values. So the tangible book value per share did also come down. But that's something that I had been expecting to happen for the past 2 quarters, and probably will continue until the tangible book value per share is sitting somewhere in the mid to high 30s. Thankfully, there's such a large margin of safety on the current price tag that even in the scenario where the REIT's tangible book value reverts all the way back to their 2019 range of about $30, there's still more than a 60% upside from the current share price. However, if the current tangible book value per share of $44.83 were to hold up, we would be able to achieve a 140% increase if the REIT can also achieve a share price in line with the net asset value. And this is where those buybacks are going to come in strong. See, for each share that's repurchased at $18.60, the shareholders are actually growing their ownership of these undervalued assets by the difference between the net asset value and the current share price, which at the moment is over $26 for every repurchase. So even though the REIT has only spent around $1 million on buybacks so far, they've actually increased the remaining shareholders' ownership of the net asset value by nearly $2.5 million. Now, theoretically, these repurchases can only go on so long as people are willing to sell their shares at these low prices. And we know that according to the management, the available float and low volume make it difficult to accumulate substantial ownership positions. So even with the relatively small amount of buybacks that have been going on, this can have a tremendous appreciative effect on the share price in theory. But whether or not that plays out in reality, we'll have to wait and see for sure. In the meantime, I'm happy to collect my dividends and enjoy watching the increasing rental income funnel back into the share repurchases, which further boost my ownership stake in the REIT. At this point, in my personal Canadian stock portfolio, I have nearly 100% of my cash invested, and almost 40% of that is held in Morguard North American Residential REIT shares. So, because of the size of my position and my current lack of available cash, I'm not really planning on buying any more shares unless the share price dips below my cost basis or if I find myself with some excess cash to invest. However, I do still plan on buying shares regularly in my public portfolio where I invest $100 every month into Canadian stocks, and all of that is documented here on the channel. So I would say that my conviction in this security is incredibly strong, but it is possible that I am wrong in my assessment, so you should definitely do your own research and come to your own conclusions before making any investment decisions. I am not a financial advisor, and this video is not financial advice. This video was made for educational purposes and should only be used as a source of inspiration for doing further research into the company outlined. After all, I'm just a Canadian who likes to invest and share what I've learned with others. In doing so, I hope that I've been able to provide you with something of value, and if I have, then please consider sharing this with others. Thanks for watching all the way to the end, and enjoy the rest of your day.